and welcome to the premium video newsletter for Friday, August 23rd, 2013. The market is lackluster today and doesn't seem to have too much directional bias, which is very typical for Fridays. We had some momentum yesterday and it looked like it was set to continue into this morning's session, but the expected rally was curbed by the weak new home sales report released before the opening bell. The report came out weaker than expected as new home sales plunged to the lowest level in 9 months. A boom in housing has been a major support for this year's rally in stocks. Home builder stocks fell after Commerce Department said that home sales fell 13.4% in July. The drop suggests higher mortgage rates are cooling demand for homes. Technically, the home building sector is below the 50-day moving average, and the trend went from strong upwards to range-bound during the last few months. On a long-term basis, I'm very bullish on this sector for many reasons, but on a short-term basis, I'm bearish. Here's where I'm coming from. Interest rates are going to move substantially higher. There's very little doubt about that on any level at this point. This is the major reason we went from a strong uptrend to a range-bound pattern. But here's the thing you need to keep in mind. When interest rates actually begin moving higher and the economy is improving, which is what we're seeing right now, something very interesting tends to happen. At first, people start waiting for rates to go back down, but after a while, they begin chasing interest rates. And what I mean by that is people will start to buy homes quicker because they don't want to get stuck with higher rates. The US public is not there yet because rates really haven't moved too much. But wait and see what happens when interest rates start moving above 5 to 6%. So I wouldn't be too surprised if we went lower during the next month or two. But as we begin getting closer to the new year and interest rates begin creeping up, home builders will begin to see more revenue come in, and that's what we're waiting for right now. The broad market shrugged off the weakness from the home building sector and added pressure from the retail sector. Much of what's helping the broad market is the technology sector, which is causing buying to come in across the board right now. Notice the low range we experienced today. This is very typical for uneventful Fridays. Right now, the momentum is definitely bullish, so let's see if we can test the 1680 level by the middle to end of next week. Additional weakness that's causing the broad market to stagnate is the retail sector. Over 7 companies came out with news that was negative for this sector, and I made a comment yesterday that based on the news, I wouldn't be surprised to see this sector at the 74 level. If the stock market gets weak and stalls, or if the tech sector stalls, it's a good possibility that we may actually go there. However, assuming the momentum to the upside in the broad market and the tech sector will continue, I don't think we will stagnate all that much. It really depends on the rest of the market right now. This is definitely one of the weakest sectors, and this is why we're monitoring it so carefully. Watch for the 50-day moving average to become the resistance level in the next few days, and we will continue to monitor for more weakness. If this is what the sector is going to do while the rest of the market is rallying, imagine the level of weakness we will see if the broad market was moving lower. Something to think about for traders who trade relative strength between two related subsectors. The bond market is finally bouncing as we thought it would. I mentioned yesterday that the bond market is very range-bound, and we will have a chance to short it at a higher price. The next upside I'm looking at is the 126 level. I want to see if we will hit some resistance there. If not, I think we may go back up to the high of the channel at the 127 level. But I'm cautious, as you know, about the bottom falling out of this market, so I'm only taking short trades. The market is very bouncy on the technical level, and we should see some continuation of today going into the first part of next week. The Nasdaq, which was unusually strong today and filled the gap that was created last week. In addition to closing near the highs, both indexes That's the Nasdaq and the S&P actually closed the week with some positive momentum, believe it or not. Right now, the strength is in the tech stocks, and we need to be mindful of that because if they start getting weak, we will have a big problem due to current weakness in the retail, financial, and the home building sector we're currently seeing. Looking at the crude oil market, I've been very puzzled by the lack of higher prices in light of the political crisis in Egypt. Egypt controls the Suez Canal and the Summit Pipeline, crucial transport routes between the Middle East and the Mediterranean Sea, through which around 4.5 million barrels of oil and refined products are shipped daily. That's daily. However, yesterday I alerted you to the fact the crude oil market is not being very sensitive to the Egypt crisis, but seems to be extremely reactive to the upcoming decision to curb the Fed bond buying program in the next several months. Evidently, the weak housing data reported earlier today gave hope to traders that the Feds may hold out a bit longer and continue buying bonds. Personally, I don't think that's going to happen, but that's what traders are thinking today. While I would think the Egypt crisis has more direct influence on crude oil prices, it seems clear that oil traders are much more concerned with the interest rates and financial stability in the USA than they are with the Egypt crisis at this time. Go figure. We rallied as anticipated yesterday, and today I believe we are coming closer to the resistance level once again. There's nothing new in terms of US economy that's scheduled to be released till mid to end of next week. So I think unless something unexpected happens, we may have a difficult time getting past the 108 level once again. One market we haven't looked at lately is the gold market. By now, most of you know my thoughts about gold, and I'm still very bearish long term. However, short term we broke out, and today we hit the first resistance level. The next level up is the 1440 to 1450, and if the momentum slows down, we may not see a higher price after that. Here's why I'm so bearish on gold. If you recall yesterday, I showed you a long-term bond graph, and I wonder if you see any similarities between the two. They almost look identical to each other. As economy improves and bond prices get lower and interest rates go higher, gold will continue moving lower. This is why I'm so cautious in warning traders against going long. The long-term trend is down, and I highly recommend you look at the long-term chart every time you get a desire to go long this market. And while we may be hiccuping to the upside a bit, the only way gold will go higher is if the US economy gets worse, and it's not in the cards long term. I hope you see there's no long-term support level above 700, so be prepared for a good drop in the months ahead. And if you trade ETFs, remember GLD is the best one that tracks gold market very closely. Looking at the Swiss franc, which is correlated about 93% to the euro currency, it's gravitating towards the top of the range. Remember yesterday I explained how important it is to see what happens when markets are near the top or the bottom of the range. If you see a strong pullback from the highs, this means there's a strong amount of support. But sometimes markets make new highs and tend to stay near those areas. We're seeing this in the euro and the Swiss franc as well. If we continue to stay near the upper area near the breakout level, there will be increased chance of moving higher, even if we don't do so for a while. The key right now is to watch the lows and see how low they will actually go. If we go much lower, the buyers at the higher levels will begin liquidating, and if we stay near these levels, it will create more force and upside momentum when we go higher. So this is an interesting time for the euro and Swiss, and I will continue to monitor it closely. But keep this in mind. The closer we stay or gravitate towards the old highs, the stronger this market will appear for buyers coming into this market and for buyers who've been in this market for a while. There's a few setups for Monday, and I will provide them for you Sunday night on our weekly Outlook video. Have a great weekend, and I'll touch base with you Sunday night.